what if the golden era of a stock market boom isn't actually a wealth equalizer, but, and really think about this for a second, an invisible wealth extraction machine designed to make you poorer?
Yeah, it's a profound and honestly deeply unsettling question.
It really is, because, we're constantly sold this idea that a booming economy is just this rising tide that lifts all boats. Like, the narrative is so deeply ingrained in us. You open a brokerage account, you buy some stocks during a massive multi-year bull market, and you naturally just assume you're building wealth.
Right. You assume you're getting your slice of the pie.
Exactly. But what if the very act of participating, what the financial industry lovingly calls democratizing finance, what if that is actually a highly efficient, mathematically inescapable trap?
And honestly, the data we are unpacking today provides an answer that is, it's going to make a lot of people deeply uncomfortable.
Oh, I was uncomfortable just reading it.
Because the mechanics of this wealth extraction, they aren't hidden in some backroom conspiracy. There's no, smoke-filled room of billionaires actively plotting to steal your money.
Right.
It's actually much more terrifying than that. The extraction is hidden in plain sight. It's baked entirely into the fundamental mathematics of how returns compound over time.
I'm so glad you brought up the math right away, because today we are doing a deep dive that totally shattered my entire understanding of investing.
It does that. It really does.
We are looking at this unprecedented, massive study conducted by three really brilliant researchers, John Campbell from Harvard, Tarun Ramadorai from Imperial College London, and Benjamin Ranish from the Federal Reserve.
And when you say massive, I think we really need to emphasize the scale here.
Yeah, please do.
They didn't just poll a few hundred people or look at simulated models on a computer. They secured access to the actual hard administrative records of the Indian stock market.
Which is wild.
Specifically, the National Securities Depository Limited. And they tracked a 10-year period from March 2002 to May 2011.
And the number of accounts, what was it?
They tracked a staggering 11.6 million individual investor accounts over an entire decade.
11.6 million. That is just insane.
It's microdata at a level that is rarely seen in financial research. And we have to talk about why this specific decade in India is so crucial to the study.
Right, because it wasn't just a random 10 years.
Exactly. This wasn't a stagnant period. It was an era of explosive, euphoric economic growth. Like, the middle class was rising rapidly, the gross domestic product was surging, and retail participation, meaning everyday people opening accounts to trade directly, it skyrocketed by 175%.
Wow. So they went from what to what?
They went from about 2.2 million active stock-holding individuals to over 6.25 million.
So we essentially have the perfect laboratory for this deep dive, like a booming emerging market, millions of new, eager investors pouring in, all of them zeroing in on the promise of the stock market.
The gold rush.
The ultimate gold rush. And our mission today is to look at what actually happened to the money inside those 11.6 million accounts. We're going to uncover the lethal hidden laws of the capital markets that cause the rich to get richer, while everyday retail investors just bleed wealth.
Yeah, and I want to warn everyone right now, everything you thought you knew about investing, about chasing high returns, and about how fair the market is, it's about to be completely turned upside down.
Completely.
And we are going to rely strictly on the math and the data here. We aren't theorizing.
No theories, just cold, hard numbers.
Right. And to start, we really have to look at the macro picture of India during that decade. There was this prevailing belief and absolute certainty among the public that directly buying stocks was the absolute best way to share in the nation's economic miracle.
Everybody thought they were going to get rich.
Exactly.
Yeah.
You had everyone from taxi drivers to small business owners opening brokerage accounts, utterly convinced this was their ticket to the middle class.
Right. It was that rising tide mentality. The pie was getting bigger. So naturally, you would assume that everyone taking a slice was getting wealthier, right? I mean, even if you accept that the rich might get wealthier slightly faster, you still assume the guy at the bottom is making, something.
You'd think so.
But this is where the data from the Harvard and Fed researchers just delivers this huge face-slapping reality check. Because they segmented these millions of accounts by size. They looked at the bottom 10%, so the absolute smallest retail investors versus the top 10%, the wealthiest accounts.
The absolute whales.
Yeah, the whales. And over this massive 10-year bull market, the 10th percentile of small accounts didn't grow. They didn't even stay flat.
They physically shrank.
They shrank.
Yes, in absolute terms, their wealth deteriorated. Like if we convert the figures to US dollars, just to give you some context, the 10th percentile account size fell from $71 down to $60 over the sample period.
Which is just crazy to think about.
Now, $71 might not sound like a lot of money to us today, but remember, this is India in the early 2000s, and we are looking at the entry-level retail participant. The key takeaway isn't the dollar amount, right? It's the trajectory.
It went down.
It went down.
While a historic bull market was literally raging outside their windows, meanwhile, look at the other end of the spectrum. The 90th percentile, the wealthy large accounts, they completely skyrocketed.
Oh, yeah.
They went from an average of $7,274 up to $19,258.
Almost tripling.
Almost tripling. So the wealth inequality didn't just grow. The data shows the standard deviation of the log account size, which is basically a statistical measure of this inequality. It ballooned from 1.85 to 2.38. The wealth didn't trickle down at all.
No, it acted like a giant vacuum cleaner, just sucking capital straight to the top.
Just a straight-up wealth extraction machine.
And that is the absolute crux of the divergence. Let me explain what that standard deviation variance really means in practical, everyday terms.
Please do.
At the start of the study, a one standard deviation increase in account size meant your account was 6.4 times larger than the guy below you.
Okay, 6.4 times.
By the end of the decade, that same statistical jump meant your account was 10.8 times larger. The gap between the haves and the have-nots in the stock market widened at just an incredible speed. The tail was stretching out.
Okay, I have to stop you and push back here because I am genuinely baffled by the physics of this.
Go for it.
Wait, in a massive 10-year bull market where the overall market index is up significantly, how does the bottom 10% physically manage to lose money? Didn't a rising tide lift all boats? Like, if I just close my eyes and throw a dart at a list of stocks in a bull market, shouldn't I make at least something just by pure accident?
You would think so.
Yeah.
It's totally logical to think so. And that assumption is exactly why so many people get trapped. You see, the retail investors didn't just throw a dart and go to sleep. They were actively managing their money, and in doing so, they stepped into a mathematical trap with literally no exits. To understand how they lost money in a booming market, we have to look at the returns they were actually generating on a monthly basis.
Okay.
And this leads us to what is perhaps the most counterintuitive, genuinely mind-bending finding in the entire 40-page paper.
Yeah, this is the part that totally messed with my head when I first read it. Because what if I told you that the poor actually beat the rich at the game of returns and still went broke?
It sounds like a paradox, doesn't it? It sounds mathematically impossible.
It sounds totally impossible.
But let's look at the numbers from the study's risk factor loading tables. The researchers calculated the monthly excess return, which is just the return above the safe, risk-free interest rate, like a government bond for every decile of investors.
And the stats are just wild. On paper, the poorest retail investors completely crushed the richest investors. The smallest accounts, the absolute bottom tier, generated a monthly excess return of 2.99%.
That is massive.
It's insane, nearly 3% a month. Meanwhile, the wealthiest accounts, the top-tier whales we talked about, they only managed a 1.70% monthly return.
Right. So that is a performance gap of 1.29% per month in favor of the little guy.
The little guy is winning on paper.
Winning big.
Yeah.
Just to put that in perspective, in the world of professional finance, an outperformance of 1.29% a month is legendary. Hedge fund managers get billionaires to write them blank checks for a fraction of that kind of outperformance.
So wait, I really need to understand this, and I want everyone listening to really track with us here. The small retail investor is outperforming the rich whale by 1.29% every single month for 10 years.
Yep.
If they are earning almost double the rate of return of the rich, why did their accounts shrink from $71 to $60 while the rich accounts nearly tripled? This violates every single instinct I have about how money works. If I earn a 3% return and you earn a 1.7% return, I should be getting richer than you. How is this possible?
Because the financial industry's absolute favorite metric is lying to you.
A mathematical lie.
A huge one. The 2.99% figure is what we call the simple or arithmetic return. It's literally just the simple average of your monthly percentage gains and losses.
Yeah.
But here's the brutal truth. You cannot spend an arithmetic return.
Right.
An arithmetic average doesn't represent the actual physical money sitting in your pocket. The true metric of wealth, the one that actually dictates the balance of your brokerage account, is the geometric return, or, as the researchers refer to it, the logarithmic return.
The log return.
Yes, this is the actual compounding rate of your capital over time.
Okay, we need to slow down and use an analogy here because jargon like arithmetic versus geometric is exactly how Wall Street gets away with confusing people.
Very true.
Let's make it visceral. Think of your portfolio like a roller coaster. Let's say you invest $100. On Monday, the market crashes and your portfolio drops by 50%. You lose half your money.
You were down to $50.
Exactly. Painful, but unfortunately a very common experience for retail traders.
Especially in emerging markets.
Right, so you have $50. Then, on Tuesday, the market rallies. Great news. Your portfolio shoots up by 50%. So what is your average return over those 2 days?
Minus 50 plus positive 50 equals 0.
0. Divide by 2 days, your average simple return is 0%. You look at your brokerage app, it says 0% average return, and you think, okay, I survived, I broke even, I'm flat.
But open your wallet.
Open your wallet. You started with $100, you lost 50%, leaving you with $50, then you gain 50% on that remaining $50. 50% of 50 is 25, so you end up with $75.
Exactly.
Your simple return was 0%, but your actual wealth dropped by 25%. You need a 100% gain on Tuesday just to recover from Monday's 50% drop.
Yet the math is punishing.
Your average return looks neutral or even positive, but your actual wallet is completely bleeding out. This is the arithmetic illusion.
That is a brilliant illustration.
Yeah.
In finance, we call the mathematical phenomenon driving this difference Jensen's inequality.
Jensen's inequality.
Yes. And without getting bogged down in all the academic formulas, the fundamental rule of Jensen's inequality is that the average log return, which is the geometric compounding return that dictates your actual spendable wealth, is always less than the average simple return.
Always less.
Always.
Yeah.
And the size of that gap, the difference between the mirage on your app and the reality in your wallet, is entirely dependent on one single factor.
Volatility.
Volatility.
Let's talk about that volatility because this is the invisible tax that accelerates your bankruptcy even when you think you are winning.
It really is a tax.
If I'm understanding this right, the math itself charges you a penalty for swinging too hard?
Precisely. To find your real spendable compounding return, you have to take your simple arithmetic return and subtract a massive penalty for the volatility of your portfolio.
Wow.
High swings, huge ups and downs actively eat your compound growth. It acts exactly like a tax. The more your portfolio bounces around, the larger the tax you pay to the laws of mathematics.
So let's look at the Indian data again to see this tax actually in action. The researchers looked at the volatility of these accounts. The small retail investors, the ones generating that massive 2.99% arithmetic return on paper.
Right, the 3% guys.
Yeah, those guys. They had extremely wild portfolios. Their volatility rate was a staggering 23.7% per month.
Which is astronomical. If we annualize that, we are talking about a portfolio that swings by over 80% a year.
80%.
It's financial whiplash. You are constantly experiencing those 50% drops that require 100% gains just to tread water.
And what about the wealthy investors? The ones who are only making 1.70% a month on paper?
Their portfolios were much, much calmer. Their monthly volatility was only 11.0%.
So less than half the volatility of the poor investors.
Exactly, less than half.
So here is the flip, and this is the core of the whole deep dive. When you apply this volatility tax, when you actually calculate the real compounding log returns that dictate the account balances, the truth finally comes out.
The math doesn't lie.
It doesn't. The rich jump to a 1.10% monthly growth rate. But the retail investors crash from their 2.99% mirage down to a measly 0.72% monthly compounding rate.
It just completely inverted.
Completely inverted. The rich are actually winning.
They absolutely are. When you strip away the arithmetic illusion and look at the geometric reality, the rich beat the poor by a margin of 0.38% every single month.
Every month.
The poor's high volatility creates this enormous wedge between their simple returns and their real returns.
Right.
Their wild swings acted as a massive, invisible tax that consumed literally all of their outperformance.
Wait, I can hear someone listening right now thinking, okay, 0.38% a month, that doesn't sound like a massive victory. It sounds kind of small.
I get that. It might not sound like much over a single month, but over a decade,
Yeah.
It is an insurmountable chasm.
Because of compounding.
Exactly. This is the power of compound interest working in reverse against the small investor. A 0.38% monthly advantage compounded over 10 years creates a completely different trajectory of wealth. It is the exact mathematical mechanism that explains why the rich accounts tripled in size while the small accounts actually shrank.
So you're saying the rich aren't necessarily picking better stocks to get higher returns. Like they don't have a crystal ball. They are just actively playing a game of lowering their variance. They're deliberately dodging the tax.
That's exactly it. They recognize that in the game of compounding wealth, minimizing your downside, just smoothing out the ride, is actually more important than maximizing your upside.
Wow.
The retail investors are playing for the home run. They're taking on insane variance, and the math of compounding is just quietly taxing them into oblivion.
Okay, but why was the retail volatility so high to begin with? Why were their portfolios swinging 24% a month?
We have to look at what they were actually buying, because retail investors think they're carefully handpicking winning companies, but the data shows they are actually just playing a very dangerous game of roulette with their life savings.
Yeah, we have to look at the actual composition of these portfolios. The data reveals a fatal flaw in the retail approach.
What did they find?
Well, the researchers calculated the average number of stocks held in each decile of account size. The smallest accounts, the ones getting absolutely crushed by the volatility tax, held an average of only 1.56 stocks.
1.56 stocks. They were totally isolated. I used the word roulette a second ago, but honestly, it's more like Russian roulette.
Totally.
Because in regular roulette, you have almost a 50-50 shot on red or black. But if you hold just one stock, and that one company have a bad earnings report or a scandal or the CEO resigns or just straight up goes bankrupt, that's the bullet in the chamber, your entire net worth takes the hit. There is zero safety net. None. And compare that to the largest accounts. The wealthiest decile held an average of 28.9 stocks.
Almost 29 stocks.
Yeah. They were broadly diversified. When one of their 29 companies had a bad day, the other 28 cushioned the blow. This is how they achieved an 11% volatility versus the retail's 23.7%.
Which is huge.
Right, because diversification isn't just about safety, like some vague concept of safety. It is the exact mechanical process by which you lower variance and increase your true geometric return.
By lowering the tax.
By lowering the tax.
This brings up another staggering stat from the paper, something that totally destroys a really common societal narrative. You know, we usually assume the rich get richer simply because they have more spare cash. We think, oh, the rich guy has a massive salary, so every month he just dumps more cash into his brokerage account. He can afford to save more, so his account is bigger.
That's what everyone assumes.
Right. But the data proves this is entirely false.
It completely inverts the narrative. The researchers performed what's called the variance decomposition to figure out exactly what drove the massive increase in the wealth gap over that decade.
Okay, variance decomposition. What does that actually mean?
They basically wanted to know, was the gap growing because new money was being deposited, or was it because of the performance of the money already there?
Got it.
And they found that heterogeneous returns, meaning the difference in how their actual investments performed due to this log return gap we've been discussing, caused a staggering 84% of the wealth gap.
84%.
Yes. Net cash inflows, people actually depositing new money from their paychecks, only contributed about 40.3%.
Wait, let me stop you. 84% plus 40% is more than 100%. How does that math work?
I'm glad you caught that.
Yeah.
It's because there is a negative interaction effect of about minus 24%.
What does that mean?
In statistical terms, it's called negative covariance. And this uncovers the most tragic irony of the whole study.
Okay, brace me.
The negative covariance means that the people who are making the largest net inflows, the ones constantly adding new money to their accounts,
Those are the poor.
they were the small retail investors.
I really need that to sink in for a moment. You know, there's this slang term used by retail investors in China. They call themselves leeks, like the vegetable.
Oh, I've heard this.
Right, because when you chop the top off a leek, it just grows right back from the root, ready to be chopped again. Retail investors get their accounts chopped down by volatility, they go back to their day jobs, save up their salaries, deposit more money into the market, and just get harvested all over again.
That is an incredibly apt, albeit very dark, metaphor.
Very dark.
But it perfectly describes the negative covariance we see in the Indian data. The small retail investors were actually adding money to their accounts constantly. They were saving their hard-earned cash from their jobs and dumping it into their 1.56 stocks.
Just constantly refilling the bucket with a hole in it.
Exactly. And what were the rich doing?
Let me guess. They weren't depositing anything.
The rich were withdrawing money. They were in a state of net outflow. They were taking their profits out of the stock market to buy houses, to consume, to fund their actual lifestyles.
This is devastating. The retail investor keeps topping up their account, trying to save a losing hand, totally exposed to the catastrophic drop of a single stock.
Mhm.
But because of the extreme volatility tax, the small investors' deposits were instantly wiped out by their losses.
Yeah, their saving speed could never outrun their bleeding speed.
It is a profound behavioral trap. Think about the psychology here. The retail investor experiences a sharp drop because they only own 1.5 stocks.
Right.
They believe the stock will bounce back, so they deposit more of their salary to average down their purchase price. But the massive variance continues to eat their log returns. They are essentially throwing good money after bad into a structurally deficient portfolio.
While the wealthy are just harvesting the steady, low-variance compounding growth of their 29 stock portfolios and literally living off the proceeds.
It's quite literally a wealth transfer mechanism. The poor are subsidizing the liquidity of the market with their salaries.
That's exactly what's happening.
Which begs the question, what exactly were these 1.56 stocks? Were they just buying boring, blue chip, safe companies and getting unlucky?
No, absolutely not.
And that takes us to what we might call toxic preferences.
Right.
The very stocks that small investors fall in love with are precisely the ones that deliver the lethal dose of poison.
To figure out exactly what kind of stocks the different deciles were buying, the researchers used a standard four-factor model. This was originally developed by Eugene Fama and Kenneth French, and later extended by Mark Carhart.
The Fama-French model, right.
Right. It's a way of measuring a portfolio's exposure to four distinct types of risk: market risk, company size, value, and momentum.
Okay, let's translate those academic terms so everyone listening understands exactly what the retail leaks were buying. Let's start with market risk, or beta.
The data shows retail investors absolutely loved high beta stocks. Their market beta was 1.21.
Okay, so for the listener, a beta of 1.0 means your stock moves exactly with the broader market. If the market goes up 10%, your stock goes up 10%.
Yes.
A beta of 1.21 means you are buying stocks that swing 21% more violently than the market itself. If the market drops, you plummet.
So they are actively seeking out hypervolatility. They do not want stability.
Which is wild. What about the next factor, company size?
They had a massive exposure to the size factor, specifically small cap stocks. Their factor loading was 0.57. They were deliberately buying the smallest, least stable companies on the Indian exchange.
Which makes perfect sense from a psychological standpoint, doesn't it?
How so?
Well, they want the lottery ticket. If you have a small account, say $500, you don't want a massive blue chip stock that grows a reliable 8% a year. That won't make you rich. You want the penny stock that might go up 1,000% next week.
You're swaying for the fences.
Exactly. What about the third factor, value?
They also loaded heavily on value stocks with a 0.45 loading. In this context, value means companies that are beaten down, where the stock price is extremely low compared to their actual book value. These are often companies in serious distress.
So they are trying to catch falling knives, basically, hoping for a miraculous turnaround.
Yes. And finally, the fourth factor, momentum. The study showed they loved trading against the momentum.
Against it.
Yes, the momentum factor loading for the smallest accounts was negative 0.36. This means they are contrarian traders. If a stock is crashing, they buy it, assuming it has to go back up. If a stock is soaring, they sell it way too early to lock in a tiny profit, totally missing out on the sustained growth.
Now let's look at the wealthy accounts, the top 10%. Did they buy high beta?
No, their beta was 1.00, exactly matching the market.
Did they buy small caps?
No, their exposure was 0.06, which is practically zero.
Did they buy beaten down value stocks?
No, negative 0.07.
No.
But they did embrace momentum. They rode the trend instead of fighting it.
The contrast is just incredibly stark. The wealthy accounts engineered portfolios to completely eliminate unnecessary, uncompensated risk. They matched the market swings, bought established large companies, and followed the positive momentum.
While the retail investors purposefully constructed portfolios consisting of a single, highly volatile, tiny, distressed company that was actively trending downward.
It's almost sad to hear it laid out like that.
It really is.
Okay, but surely the rich guys just had better insider information, right? Don't they have an alpha advantage? We always hear that the game is rigged because the rich have better research, better Bloomberg terminals, better inside tracks on what the companies are actually doing.
It is true that the wealthy had a better alpha.
Ah.
Wait, alpha is essentially the excess return that cannot be explained by those four market factors we just discussed. It's often used as a proxy for raw stock picking skill or an informational advantage.
Right.
The data shows the richest decile had a positive alpha of 0.40% per month, while the poorest had a negative alpha of 0.17%.
So there is a gap.
Yes, there is an alpha difference, a skill or information gap of 0.57%.
See, I knew it. The game is rigged. The rich are just better at picking stocks because they have better information.
But here's where we have to look at the whole picture and why this study is so groundbreaking.
Okay, I'm listening.
Yes, they had a 0.57% alpha advantage. However, the researchers' decomposition proves that this skill was just a bonus. It was not the main engine of their wealth.
It wasn't.
No. The ultimate weapon was their risk management and diversification. The researchers mathematically demonstrated that even if you completely erase the alpha, like if you assume the rich had zero stock picking skill and zero informational advantage over the poor, the rich still win.
Because of the volatility tax.
Because of the volatility tax.
Yeah.
They won by not losing. They won by holding 29 stocks instead of 1.5, neutralizing the idiosyncratic risk that completely destroyed the retail investors' compounding returns.
That is profound, like really profound. The rich aren't getting richer because they know which stock will double tomorrow. They are getting richer because they know how to build a bunker that survives the winter. Their primary skill isn't predicting the future. It's mitigating variance.
Absolutely. Mitigating variance is the real secret.
But here's the cruelest twist of the entire 10-year study. Because the worst possible thing that can happen to an amateur gambler is getting incredibly lucky on their very first bet.
Oh, it wires their brain entirely incorrectly.
Exactly.
And this is where the behavioral psychology merges with the quantitative data in a truly tragic way. When we look at the specific toxic factors the retail investors loved, those highly volatile small cap and value stocks, we have to look at how those factors actually performed in India between 2002 and 2011.
And they went on an absolute tear. During this specific 10-year window in India, small cap and value stocks historically overperformed compared to long-term global averages.
Massively overperformed.
The value factor alone yielded 2.49% a month. That is insane. Globally, over the long run, the value factor yields something like 0.33% a month. In India, for this decade, it was almost 8 times higher.
So the retail investors were taking terrible, completely undiversified risks, but the specific pocket of the market they were gambling in happened to experience a historic, localized boom.
They were insanely lucky.
Very lucky.
And this gave them those massive, intoxicating arithmetic returns. It gave them the 2.99% average simple return we talked about earlier.
Which was the illusion.
Right. But this luck was actually a poison. It reinforced their gambler's mentality. It convinced them that their strategy of holding 1.5 stocks and trying to catch falling knives was actually a brilliant strategy.
Yeah, it masked the volatility tax just enough to keep them playing, to keep them depositing their salaries into the machine month after month.
Exactly. It's operant conditioning. They were being rewarded for bad behavior.
They really were. But the researchers asked a chilling counterfactual question in the paper.
Oh, I love this part.
They asked, what happens if we strip away this localized historical luck? What if we simulate their exact same portfolios with the exact same 1.56 stocks and the exact same contrarian trading behavior, but we use normal, long-term global market conditions instead of the localized Indian boom?
The reality check.
The ultimate reality check.
And the answer is just terrifying. If you strip away the luck, their true expected compounding log return plummets to a horrific negative 1.71% per month.
Negative 1.71%.
Yes, negative. In a normal market, without the tailwind of a historic anomaly, their wealth destruction isn't a slow bleed. It is a rapid hemorrhage. They would be losing nearly 2% of their wealth's compounding power every single month.
It's hard to even fathom losing that much continuously.
Let me translate this, because this is the core of the issue. In a normal market, the small retail trader isn't just treading water. They were taking a guaranteed systemic loss every single month, effectively acting as the combustible fuel powering the wealth expansion of the rich.
They're the liquidity providers.
They are. They are the ones eagerly buying the risky, volatile assets that the rich are smartly offloading to lower their variance.
It is a very sobering realization. The high arithmetic returns they experienced were merely a temporary smokescreen that hid the structural inevitability of their ruin.
Yeah.
The math dictates that without diversification, a high-variance strategy will ultimately grind your geometric returns down to zero, or in this case, deep into negative numbers.
Which naturally leads us to the big why. Why did this happen? We have to ask, Why were they allowed to fight this battle totally naked?
That's the institutional question.
Right. Because the narrative is that democratizing finance, letting everyone trade on an app is a public good. But this data shows it didn't eliminate inequality. It built a hyper-efficient pipeline to transfer wealth from the poor to the rich.
The root cause of this tragedy really lies in the institutional structure of the market at that time. Why did Indian retail investors fight naked with just 1.56 stocks? Why didn't they just buy a broad index fund or a mutual fund like we are all told to do today?
Yeah, why not?
Because in India, between 2002 and 2011, they lacked the institutional safety nets common in developed markets. Mutual fund penetration was virtually non-existent.
The paper points out that mutual funds had less than a 5% market share.
Negligible.
And 65% of households that held stocks held absolutely zero bonds or mutual funds. They had no padding.
Without cheap, efficient diversification tools like ETFs or index funds, they were forced into raw, hand-to-hand combat with the market. They had to buy individual stocks because that was literally the only accessible vehicle for a retail investor to participate.
And think about the mechanics of this, practically speaking. When you are a small investor with limited capital, you can't afford to buy 30 different individual stocks to build a properly diversified portfolio. The transaction costs, the brokerage fees, they would eat you alive.
Right, the friction is too high.
If I only have $100, I can't buy fractional shares of 30 companies. I have to buy one share of one cheap company. So the institutional barrier itself forces me into under-diversification. I buy one or two stocks, I accept the massive variance, and I unknowingly subject myself to the volatility tax.
Precisely. They were set up to fail by the very structure of the market. And this connects to a much bigger macro perspective that I think is absolutely crucial to mention here.
Yeah, let's zoom out.
This study is a profound micro-level validation of Thomas Piketty's famous thesis on capital.
Thomas Piketty. He wrote Capital in the 21st Century. Can you unpack his thesis for us and explain why this study proves it?
Sure. So Piketty's core argument is encapsulated in the formula R is greater than G. The return on capital, which is R, historically grows faster than the rate of economic growth, G.
Okay.
But more specifically, he hypothesized that wealthier people obtain higher average returns simply because they have more capital to deploy.
Just by virtue of having more money.
Right. And critics often argued against this, saying that in efficient public markets, everyone has access to the exact same returns.
The idea that money makes money, and big money makes big money faster. People usually assume that's just because the rich can invest in, private equity or hedge funds or real estate deals that normal people can't access.
Exactly, the secret door theory.
Right.
But this paper proves the mechanics of how wealth concentrates, even when everyone is. In the exact same asset class. Public stocks on a public exchange. Piketty's fear is proven right here on a micro level. Capital automatically concentrates at the top because the wealthy have the scale to lower their variance.
Wow.
It's not just about access to secret private deals. Even when playing on the exact same public exchange, the rich can afford to buy 29 stocks, reduce their idiosyncratic risk, completely dodge the volatility tax, and harvest a higher geometric return. It is an automatic self-accelerating law of math.
The rich don't even need to be smarter.
No.
They just need to be bigger.
Exactly. The scale itself is the advantage because scale buys diversification, diversification kills variance, and killing variance maximizes the log return.
It is brilliant, and it is absolutely brutal.
It is the hidden logic of the world. Lowering the barrier to entry to a financial market, just letting anyone open an account without simultaneously providing low-cost tools for diversification, is not true democratization. It is simply expanding the pool of liquidity that the wealthy can harvest.
Okay, we really need to take a breath and recap this journey because this has been heavy, and it completely reframes how I view the stock market now.
It's a lot to take in.
We went from looking at a booming decade in India with massive retail participation, a true economic miracle on the surface. But underneath, we exposed the illusion of high arithmetic returns. We saw that the poor were making almost 3% a month on paper, but physically losing money in reality.
Right, because we uncovered the lethal volatility tax.
Driven by Jensen's inequality.
Yes, which showed how the wild 24% swings of the retail portfolios destroyed their compounding power. This flipped the real geometric returns in favor of the wealthy by 0.38% a month.
We busted the myth that the rich get richer just by saving more. We saw the tragic loop of the leaks, retail investors constantly depositing their salaries into 1.5 stock portfolios, trying to catch falling knives, while the rich casually withdrew their low-variance profits.
And we saw that the retail investors' localized luck in small-cap value stocks only served as a poison. It reinforced their gambling, hiding the fact that in a normal market, they were guaranteed to lose almost 2% a month.
And finally, we realized that without cheap, accessible diversification tools, retail traders are just mathematical sacrifices to the wealthy. It perfectly proves Piketty's thesis that capital naturally concentrates at the top due to the mathematical scale advantages of variance reduction.
It fundamentally changes how you look at everything, doesn't it?
It really does. Which leaves me with a final, honestly chilling question for you to mull over.
I'm ready.
Think about the modern world right now. We have zero-fee trading apps on our phones.
Yeah.
We have fractional shares. We have massive gamified crypto frenzies and meme stock explosions.
Everyone's trading.
Everyone. We celebrate how accessible the markets are today. How anyone can open an app and buy a dog-themed coin or a volatile tech stock in 3 seconds.
Democratization.
So they say. But as millions of new, undiversified retail traders flood into these hyper-volatile assets, chasing the highest possible arithmetic returns, have the rules of the game actually changed? Or when the tide finally goes out, will we find out that we haven't democratized anything at all and we've just built a faster, shinier version of the exact same wealth extraction machine?